Hi, hello friends. Welcome everyone to Invest10, India's largest retail investors online conference. I'm Ashok Devanampriya, the CEO of Traders Gurukul and also the host for your today's program. It's a great pleasure to invite every one of you to the most influential stock investor conference of the year. I'm sure by the end of today's session, you will have additional knowledge with respect to making better decisions in your investing life. Let me thank our media partner Money Control Pro, the largest financial portal in India with millions of daily readership on their website. I would also like to thank and appreciate our title sponsor Sharekhan, one of the leading stock brokers in India with millions of investors as their customers. They offer online security brokerage portfolio management services to institutions, large corporate houses, and individual investors. They serve customers in India from the last 37 years. The speaker for today is Mr. Vishal Jadiya from Vadodara, Gujarat. He is an investor, banker, enthusiast, opportunist, and always looks for calculated risk-taking activities. He has been in the investing domain from the past 12 years, ever since 2008, rather 14 years now. He has the expertise in picking some of the best multi-bagger stocks. In fact, Vishal even suggested a couple of them to me during our interaction in the last 5 years. So let's hear from the host today. Dear Vishal, on behalf of Traders Gurukul, Money Control Pro, Sharekhan, I extend my warm welcome to you into this program as a speaker. Go ahead, my friend. The stage is yours.
Thank you, Ashok. Thank you, Sharekhan. Thank you, Money Control. Thank you, Investor, and thank you, my dear friend Ashok Devanampriya. Hello and welcome everyone to this webinar. From the introduction given by Mr. Ashok, you guys might have already realized that this person sitting today here is not any extraordinary personality. If you had thought so, then you all are right. I'm a very simple investor and I don't have any extraordinary degrees and certificates to be qualified as market expert. So, why Ashok has invited me here today? Why would a genius like Mr. Ashok has invited me here today to deliver my investment methodology to this large number of audience? Answer to this goes back to 2015-16, where I and Ashok got connected due to our Telegram channels and common groups. We used to discuss on stocks and share our techno-funda ideas to each other. Then I met him personally in Mumbai in 2017 and we discussed about his algo trading journey. He explained me how he is getting very good returns over his algo trading strategy that has around 55% accuracy in trades. I told him that apart from investment, I also do intraday or positional trades with around 70-80% accuracy. And he was surprised. He said, Bagar, that's too good to be true. Then I showed him my trade book for the year with around 77% of accuracy. And he asked me if we can code it for an algo. Somehow it didn't ended up at any algo coding due to scalability of our methods were different. As he was working in large caps and my trading were always in small and mid caps. So, but after that we stayed in touch. And he has also witnessed some of my multi-bagger investment ideas. For example, some years back, I have invested in a penny stock, Savaria Consumer. First of all, let me clarify whichever stocks we discuss here are not at all should be considered as my recommendations. And you should always check for a technical aspect, fundamental aspect, and you should take advice of your research analyst before taking any action. Yeah, so let's continue. For example, some years back, I have invested in a penny stock, Savaria Consumer at ₹3, and it went up to 27 to 30 rupees within a year. That was 10 times returns. In 2020, I have found another gem, multi-bagger penny stock, which is now close to a large cap. Yeah, the company was a micro cap when we found it, and now it's a large cap. In the end of 2020, I have found a penny stock named Brightcom Group. I think all must have near that name by now, which was trading at around 5 rupees with some issues like NCLT pending against the company. But I saw that the company is making 10 times more than of outstanding dues to be paid by the company for which they were presented in NCLT. Then why would they lose the business for this outstanding amount against it? For a very small span of patience, the things took turn and all the cards were in favor of the company. The company has paid outstanding amount and got clean sheet from NCLT. They have also raised funds at 8 rupees for the amount greater than their market cap. Stock price started improving simultaneously with their balance sheet, and they gave bonus in the ratio of 1:4 in the month of August 2021. Stock price along with their business kept increasing, and the stock price went above, recently before a month, it was about 200 rupees within a year. That's almost more than 50 times if you calculate cost after bonus issue. So how could I see 50 times growth in a stock? There were actually there was no rocket science. Let's discuss that point by point. First, I saw that the book value of the share was around 50 rupees at the level. That was 10 times the price. And second, as I said, the case was pending in LCA against the company. But why would the promoter lose a profit-making company for a very small amount of dues against them? Third, it was a profit-making company. Fourth, the company was in EdTech business, which was in high demand during COVID period due to increasing online time of users. Another thing, I saw that the company was well established over many countries in the world with qualified staffs. Mainly, they do business in Israel, I think. Yeah.
Vishal, one quick check. Are you changing your slides?
No, sir.
Okay.
I'll change it. I'll change it. Yeah, I'll change it afterwards. I'm
Just
just
wanted to
giving
be
the introduction.
No problem. Carry on.
Yeah. Let me again give you disclosure that I was holding stock that Brightcom Group around 5 rupees level, and I'm also holding the stock right now. So my, what I saw can be biased, and my opinion can be biased, but you should not take any action on of what I say. So what kept me holding it even after decent gains and lot of ups and downs? The company delivered around 100% growth in numbers as per their earlier given earning guidance. Then another thing I saw that management is always up for investor queries and keep informing exchange about all the developments. They also are holding investor con call at regular interval and answer to all the queries. Then the company has announced dividend in December 2021. They also announced bonus in 2022 in the ratio of 2:3. The stock was included in various BSE NSE indexes, and now it's also part of MSCI index. FIIs have also bought a good quantity recently as per MSCI data. So all these things are not part of any rocket science, but very simple. If you can regularly check on undervalued companies and then filter it for potential turnaround stories, we'll see it how to do that. Investors generally make mistake on betting upon past winners. What gone is gone, but the future is in our hand. So instead of hoping that ITC would again give 100% gain every year, you should keep changing. Now let's move on to the next slide. So why should one consider investing in equity as a long-term investment asset? So here you can see that I took data from past 20 years. In the year 2002, Nifty was around 1,000, and now it's around 18,000. So 18 times returns. Sensex also gave 20 times returns. Gold, in the other hand, which we call the safest investment, has given 10 times returns, and real estate has given around 6 times returns in last 20 years. So clearly equity is the winner here. So before we move into the next slides, I want you to also get a clear idea. Major time people say tell to me that this domestic news and international news and this rate changes news, how it impact us. So here I have made a simple graph. We can see indicator favorable impact and unfavorable impact. GDP growth, favorable if GDP growth is high, unfavorable if is low. Domestic saving rate, favorable if high and unfavorable if is low. Interest rate, low interest rates are good for companies to grow, and unfavorable if interest rates are high. Tax rate should always be low, as you know it. Inflation should be low, unfavorable, high. IIP industrial production, companies production, industrial production should be high for favorable impact on market, and low, and if it's low then unfavorable. Balance of trade, if balance of trade is positive then favorable, otherwise negative. Balance of payment, if positive then favorable, if negative then unfavorable. Foreign exchange position, if a country has a high foreign exchange position, same with the company, then high, otherwise low. Fiscal deficit of the country, if it's low, deficit should always be low, na? If it's low then favorable, if it's high then unfavorable. Agriculture production, favorable is high, unfavorable is low. Infrastructure facility should be good for favorable impact, and if they are not good then it's unfavorable. So it's today's session is all about Vishal's investment methodology. So what do I see in any company for investment? So before moving to the next slide, I want to tell you that you all can search Google for market related books, and you can read so many books. You can see this global data and various charts through website. So what I have done here, I have not gone into all these complexities. I have tried to make my presentation as simple as can anyone understand. If you are a new investor also, you can understand this presentation. So from next slide, I will share with you all that what I see in any company for investment. Some key areas to look before investing in any company, building a portfolio. You can see from the picture that like a detective, and any portfolio manager's work is like a detective. You have to see everything. You have to read everything. You have to gather data. You have to check on whatever is gathered, and then you have to act on it. So what we'll see here is assessment of risk reward ratio, diversification, studying news announcement, bulk block deals, study on management, adoption to digitization, how long to hold on a stock, when to book profit or loss. Assessment of risk reward ratio. If you are making any conservative portfolio, then preferably you should pick blue chip stocks. They'll easily give you 10 to 15% return in long term. If you are a risk taking enthusiast, then combination of blue chip and quality mid cap stocks you can take. It can give somewhere around 20% return, and the risk is also high. For high risk taker, combination of small and mid cap, micro caps can also be added with a maximum ceiling of 10% of total portfolio value. What I do when I build portfolio for me or any of my friend is a high risk taker portfolio. Generally, it can give return anywhere around 35 to 70%. Also, it has given return of around 70% also. And last year it was a boom market, so the return was around 130%. But yeah, in the same time, the risk is also very high. You can expect same amount of negative side too. So you should always select stocks and build your portfolio as per your risk bearing capacity. Then selection from different sectors, diversification. Sometimes weightage on single sector increase in high risk reward portfolio whenever the sector is in boom or tailwind. Focus on fundamentally sound companies only. Give them a time to reflect on share price appreciation. What happened here? When I bought Brightcom share at rupees 5, the price was stagnant for almost 6 months. But when it started increasing, within a year, it was 50 times. So when you are confident over any stock, you should give it a time. Have confidence on your investment, but never fall in love with your stocks. It will break your heart more brutally than your ex. Yeah, that's right. Don't keep on stocking a single stock. Abhi, what happened if you have invested in some stock and then you get out of the stock when there is some negative news or there are some factors, then you keep on relooking that stock. No, if I have stayed invested, what would have happened? What would have happened? The stock is 3 times now. But that energy, that time, that if you put your mind other way, if you put your mind in finding other stocks, selecting very good fundamental companies, then you can earn more than that. So instead of regretting, just see that there are more than 7,400 listed companies, and you have to build your portfolio with only 20-25 companies. So never fall in love with any single stock. Here we see a difference between dividend stocks and growth stocks. If you are building conservative portfolio, then preferably you will take on dividend stocks. Then otherwise, if you are risk taking or high risk takers, then you should go with growth stocks. So what are dividend stocks? Cash inflow from the stock at periodic intervals. You will get quarterly, half yearly, yearly dividend, final dividend, mid-year dividend. And growth stock, they have cash inflow. They have limited cash inflow. They have high investment requirement. They have to purchase new assets. They have to do expansion. Dividend stocks, release of excess return, and growth stock, reinvestment of excess returns. Return from dividend, it is tax free up to rupees 5,000. The law come recently, and above 5,000 you will have to pay 10% TDS. Okay, dividend stock offer consistent cash flow, which is potentially less risky than growth stocks because the investor is getting money at regular intervals. You see, there are stocks like Coal India, NTPC, NMDC, REC, SAIL. All these stocks are paying a high dividend. Why? Because they have already expanded to their optimum capacity. They don't need any further expansion. So whichever they are getting, they are passing on to investors as a dividend. Whereas growth stocks have the potential for higher returns for investor. Growth stocks are compatible for those investors who are not looking for instant cash flow and are looking to stay invested for a longer time. High dividend yield stocks may not always be a good sign since the company is returning so much of its profits to investors rather than growing the company. Growth stocks reinvest the profit towards expansion of the company and can give better rewards in terms of stock price appreciation. You see this.